I'm a little worried about this all-time high attempt due to 3 bearish divergences. And don't get it twisted, I'm not shorting the market just because of a feeling, but I'm not quite as confident in this high as I was through the rally in July. With CPI this week and a hot services PMI number last week, the market may just be waiting for an excuse to sell off again. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY weekly time frame talking about candle structure and location, as we always do. In terms of structure last week, solid green-bodied bar with a very strong close from the buyers at the top end of the weekly range. Structure is absolutely bullish. In terms of location on the bar-to-bar count, notice the higher low as well as the lower high. That would mean we have a classic inside bar setup here, which is typically neutral in terms of location. However, I would take it one step further and infer what should have happened from a sell-side perspective after the close of the candle from last week, 2 weeks ago at this point. It was a bearish engulfing bar, which typically indicates bearish momentum, of course, noting that we opened over the previous week's high and closed under the previous week's low, indicating as well a failed breakout over the multi-week balance range from back here. So if we put ourselves in the shoes of sellers, what ideally do sellers want to see? Of course, it's continuation in the downward direction. And you'll notice that the open of this week's bar was actually back inside of this multi-week balance range from here. So did the sellers have an opportunity to yield a weekly lower high on the bar-to-bar count more substantially inside of this 3-week balance range? The answer was yes. And the question is, did it sustain? The answer is no. So the close back up here towards the highs of the bearish engulfer does strike me as being slightly more bullish than bearish. Of course, the next concept for bulls to continue this trend would be some sort of new higher high in the trend count, and keep in mind that the overall weekly trend remains up. We have lows, higher lows, soft higher lows. This could act as another soft higher low in the trend count, and of course these are the highest highs in the trend count overall, undoubtedly much higher than the previous all-time high. Which leads me to my next point. Even if the sellers did get continuation underneath the bottom of the red bearish engulfer, we knew that we had potential weekly support over the previous all-time high, and as of right now, this would just strike me as bullish digestion, bullish consolidation towards the all-time high. If we come in with a Fibonacci, it would just reinforce this perspective. Coming from the bottom of the rally since the China gap up, the deal to make a deal back over here in May, you can clearly see that the bearish engulfer did not even make it to the Fib 38.2, classifying all of this as bullish consolidation from a flag perspective, measuring from point A up to the all-time high at point B. So bullish from there. If we take a look at the anchored VWAPs on the weekly timescale, we're above the entirety of the stack. Even if we take the anchored VWAP from the breakout candle here, which the bearish engulfer closed underneath, we opened the week above and we actually closed the week back up at the all-time highs basically, so we're bullish above the entirety of the stack. Once again, we can come in with the final study on the weekly, which of course is the volume profile, and we wouldn't be surprised to see anything other than just a hold over this high volume node here, and there's thin volume overhead, rightfully so, because there's literally not many transactions taking place up at these levels. So all things considered, the higher time frames remain absolutely in control of the buyers at this point in time. If we take a look at the daily time scale, this is where things got a little bit shaky due to the gap down on the Friday session of now 2 weeks ago, but you can clearly see the market's recovered quite substantially, and we'll talk about the trend in just a moment after we acknowledge this week's expected move. If you're not familiar with the expected move, it's this gray box, and you can check out the video tutorial on how to set this up in the top right-hand corner. If we're contained by the upper bound, the number's at 646.25, implying a brand new all-time high, a new higher high in the daily trend count. And if we're contained by the lower bound, the number's at 628.11, implying a higher low in the daily trend count. So I would say the expected move is absolutely bullish. The next thing is just, what is the daily trend count? Well, recall that we've really been battling the tension between timeframes, right? From here to here, that gap down on the Friday session of 2 weeks ago with follow-through, we really just produced an equal low in the daily trend count. The ideal higher low would have remained over the top end of the balance range here, but that was not the case. So is it possible that the daily trend maybe got close to neutralizing there? Perhaps, but what the bears really wanted to see was a lower high underneath the bottom of this range right here. Remember, we had a 1, 2, 3, 4-day balance range, which ultimately broke down. So if you're a bear, what you would have wanted to see was this, for that right shoulder we've been talking about if the daily trend was going to reverse, another equal low, and then a breakdown to get to the weekly retest of the previous all-time high. Now, given what happened on Thursday and Friday of this week's session, you can clearly see that bears are unable to accomplish that lower high underneath 634.50. And therefore, as we said in the Wednesday midweek market update, it probably makes more sense to lean into the higher time frame trends here. The monthly trend is up, the weekly trend is up that we were just talking about. The daily trend at best got close to neutralization here, but it never actually flipped to down. So in my view, this equal low now has an opportunity to yield a higher low. Let's say that the market does pull back more aggressively and it does fall into an hourly downtrend. If the market can support over the lower edge of the weekly expected move over the top end of the previous balance range here at 627, I would still qualify this as a potential higher low. So let's play devil's advocate. If the market breaks underneath Friday's low, lower highs here on the hourly chart to produce an hourly downtrend, my first thought would not be to sell this market and oh my goodness, we're going to zero, but it would be to look for right here the possibility of a daily higher low in the trend count. But Matt, I thought in the introduction you said that you're a little worried about the high. I am, but only in the sense that I would not be a big, bold, aggressive bull trying to guarantee or force some kind of breakout through the all-time high, and we'll look at these divergences in just a moment. But in the daily perspective, or on the daily perspective, weekly perspective, all things are still firing on the bull cylinder. If we take a look at the lows of every single daily candle, 1, 2, 3, 4, 5, 6 days of now one time framing, which means that every subsequent daily bar holds a higher low over the previous day's range low. That is the case. Again, if we take out Friday's low, I might be inclined to think that the hourly trend could flip to down here, but I would still maintain that the base case is seeking a higher low and some sort of continuation that looks like this. This would be your higher low zone, lower edge of the weekly expected move, and I'll say it one more time, 627 here. Now, something to carry forward in the narrative, and we've been talking about this for a number of weeks now, really ever since it happened on this Thursday gap up of now 2 weeks ago, is the overnight all-time high that was produced. It's up at 641.60. Doesn't need to be repaired. We don't need to go there tomorrow, the next day, or the day after that, but it should be carried forward in the narrative as an upside target. If we go there, once again, that's 641.60, I would gauge the response from the market when and if that is tested. Now, it's not all rainbows and butterflies here because you can see every single time the market tried to gap up, this Tuesday was a gap up over Monday's high, the market faded to the downside. On Thursday, the market gapped up more substantially, well above the Wednesday high, and yet the market faded in the downward direction. So do we have the most confidence from buyers in this market? I would argue the answer there is not really. It's not the most confident buy-side market, but nonetheless, it is an uptrend on both the daily timescale as well as the hourly timescale, which we'll see in just a moment. The final thing we should talk about here is the possibility of just straight-up continuation. If the market does get something that yields an outcome like this, that is a-okay. There's nothing wrong with a potential higher low over the previous regular hours all-time high at 639.89. If this higher low Brigade bolt happens, we will trade the chart in front of us, but there are some concerns based on these three divergences, which we'll get into starting on the internals in just a moment. But before getting there, let's knock it on down to the hourly time scale, and let's take a look at what's going on. Again, you can see the gap and fade. The gap and fade. It's very, very low confidence on the upside. This is like a quick squeeze out of the gates and a slow grind into the afternoon, reaching back up towards that Thursday high. Nonetheless, the hourly trend remains in the upward direction with lows, higher lows, higher lows. This is a technical higher low, and along the way, of course, highs, higher highs, higher highs, higher highs. So what does that mean in the trend count? Technically speaking, the SPY can pull back on the hourly and support a higher low here for some kind of pathing that looks like this, targeting that overnight all-time high, and that would remain bullish. This is a 1 hour higher low. If we pull back and go here, I would still argue that is a 1 hour higher low. Let's actually remove the 1H so we can draw this path in a little bit more cleanly. We'll get the Picasso going here. Look at that, beautiful, right? This is another opportunity here. Now, what's the threat with this opportunity? The threat is, if you're a bear, what you want to see is a rejection off of this level to produce the hourly downtrend, right? Because now from here to potentially here in the dotted path, you have an hourly lower high in the dotted path. And what would the target be? Well, of course, the equal low, and then ultimately this level here at the 627. What did we just talk about on the daily timescale when and if we get to 627? This is where ideally buyers would step up for your daily high or low. So the competition of the time frames is still very much so alive, just like it was back over here. Was this going to be a lower high, or was it going to be a higher low? Obviously, hindsight tells us it was a higher low. So we want to maintain a little bit more of a bullish edge in this market. We're not really seeing strong sell-side activity based on the one time framing higher we just described on the daily. Every single daily candle has a higher low in the trend count, right? But we will be open-minded to, if this is going to yield ultimately a stronger double top, this could be what kicks it off when we get here. First thought is primarily looking for that. Let's just go in with the daily, right? If we were to get something that looks like this, much more concerning. This would be like alarm bells start going off if the market fails back below 627. As you can see, it would be a failure of the lower edge of the weekly expected move as well. Let's come in here with a couple of Fibonacci perspectives. Of course, it's no doubt, it's going to be a no-brainer. From top to bottom, excuse me, we're well over the Fib 61.8, which dramatically increases the odds of going back to the 100% retracement. What you'll notice here is that the Fib 61.8 actually coincides with, or is confluence at that 632.25. So if the market does pull back and offer something that looks like this, let's say like that, right? This is kind of your botched inverted head and shoulders. It's still a technical hourly high or low. Over the fib level, I would stay on the bull side and probably get more active on the long side, seeking some kind of actual position over 634.50, targeting the all-time high, right? That's one way to play this out. You'll also notice that the Fib 38.2 is confluence with the 627 mark, meaning if this was going to yield bear flag consolidation, sellers ideally would have kept price here and then offered a Brigade bolt that looked like this for downside to really achieve the pullback on the weekly time scale into the previous all-time high. Clearly, that did not take place, and I would still use 627 as a potential area for a daily higher low first before changing my tone to being aggressively bearish. You could also think of it from this perspective. I know this is sort of like moving through the time frames now. Forget about the possibility of the head and shoulders, right? Because the lower high isn't there. If this is just going to be a double top, it actually doesn't change the neckline. The neckline would still be here at 618.50. This is where you would actually bring in a lower low on the daily time scale, right? Let's come in here with the final study on the hourly chart, which of course is the intraday anchored VWAPs. There it is. And what you'll notice is that the cluster is starting to stack in locations where you would actually still achieve an hourly higher low. If you take, whoa, funky zoom, thank you, Thinkorswim, sorry about that. If you take this previous anchored VWAP, that's the first major higher low after the rally up to the all-time high. That is confluence with 632.25. It's not the strongest VWAP, but if we take the all-time high anchored VWAP and the low from the jobs report gap down VWAP, those will slowly, over the span of the week, right, possibly start to coincide with that 632.25 as well. If it's early in the week, it's still an opportunity for what I would consider an hourly equal low at the 629.70. Not really a strong place that I would want to see the market, and I would really probably fall into the category of being very open-minded to a lower high in this range for an hourly trend reversal if that was tested. Right, so picture perfect is that the buyers keep it up and over 632.25 on the hourly. That's like full steam ahead, longs here and longs for something that looked like this, as we've just described. If we move deeper than that, I would say that there's an opportunity for this some sort of arbitrary lower high, either here or maybe it is even up at 634.50 again. The hourly trend flips to down. When we get here, it's all aboard the opportunity for the daily higher low, the DHL shipments, as we say, and we can clearly see all the confluence in the levels that we've just described. That is what I've got for you in the Spiders Cash ETF. Let's take a look at our market internals. Are the internals confirming or denying? First of all, if you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. What do we see here? Well, this is one of the first big divergences as the market makes a move back up towards the all-time high, basically. Are the market internals suggesting that we have new money buyers getting active in this market? The answer is actually no. Take a look at the volume flows here every single day of the week outside of Monday, where the market had decent volume inflows, right? That was really a squeeze day outside of Friday's oversold condition from 2 weeks ago. The volume flows here are abysmal. It's not even like, the argument is not to say like, oh my God, the market's going to crash and burn and go to zero. Just like we don't have strong volume inflows, we actually don't have strong volume outflows either. But the burden of proof is on the buyers right now, simply noting that we are accelerating in the upward direction, testing that all-time high. You'd like to see a little bit more confident of a look here at the exchange level, and you're just not getting it from a volume perspective. If you take a look at the advanced decline line, none of the days were spent in trend higher zone outside of that Monday session. Monday was really the outlier, and you can actually see that the index score has been really flat, even on the up days, right? These upside index scores are not getting double digits substantially on those sessions. If you take a look at the cumulative builds out of the tick, very, very lackluster here, even on the upside days. And once again, with the burden of proof being on the bulls right now to continue to express strength and that this market is going to get continuation, it's just not all the way there. So when I say in the intro that there are 3 divergences, this is just one of the 3 that I'm really making note of and taking to heart, right? The internal screen is like my holy grail of trading intraday. I put a lot of emphasis on what's going on here. So please understand that at the exchange level. If we take a look at the market profile of the ES, this is where things get a little bit more bullish just because of the expression of value moving higher on Friday in particular. If you're not familiar with market profile, check out the video tutorial in the top right-hand corner. But what you'll notice here is that on the Thursday session, that big gap up day, this is where we opened on Thursday morning. We actually ended up closing down here inside of that Wednesday range. Notice that value was overlapping to down. The point of control was absolutely down on that Thursday session. What's interesting about Friday, of course, is just the fact that value is actually finally starting to move in the upward direction. If you were to consider where value was all throughout the week, right? Here's Monday, here's Tuesday, here's Wednesday, here's the Thursday session, right? Price gets a little bit of exploration above. Price got a little exploration below on that Monday session, but value was relatively unchanged through the week. So Friday's little expression of an upside pop here does start to make me lean a little bit more bullish. And I would just carry forward that as long as the market can sort of stay over this 63.70 zone on the ES futures, that would be a good first step in terms of the buyers continuing to express some upside momentum here, right? The last thing to maybe say is just that value on the Friday session was in the upper distribution of the Thursday session. If you take a look at Thursday, there's a little string of B period single prints right here. And if the market were to have found acceptance on Friday underneath in what we would just consider distribution 2, let's call it, that would be slightly more bearish, or at least at bare minimum neutral, right? Because value is not changing. The fact that we did accept in distribution 1, let's call this D1, is slightly more bullish than it is bearish, okay? That's the market profile. Let's quickly zoom in on the high of Friday. Lack of material excess at the high of day there. So I would call that a poor high on the Friday session, typically in need of repair. Post-market on the Friday session before the closure for the weekend, looks like markets are slightly higher. We'll see where we wind up on Monday, but ultimately understand if we open in range here and we test Friday's high, that should lead to a break, noting the poor high. Okay, let's get back on over to the platform here. Let's take a look at our good friend, the QQQ NASDAQ, nasty NASDAQ QQQ weekly. Let's get it started with that clean drawing set, and let's make sure we can see our key 50 and 200 moving averages here. There we go. So QQQ has a little bit different of a bar. It's still an inside bar, but the high is much more equal in nature. So let's just start with our base analysis, right? Candle structure, solid green bodied bar, same thing. Nice close at the high of the week. In terms of location, again, higher low, but a much more equal high here instead of a lower high. It's still an inside bar, and a lot of the same takeaways actually apply here to the NASDAQ. Stronger sellers ideally would have opted for a breakdown and continuation of the bearish engulfer, and it simply didn't happen. As soon as we take out, if we take out, the high of the bearish engulfing bar this upcoming week, I would start to invalidate the strength of that bar, and we can just see in terms of the overall trend count, it's obviously up. This is the highest high in the trend count. We're well above the previous all-time highs. So all things considered, the chart on the higher time frame still leans on the bull side of the market. If we come in here with the fibs, well over the fib 38.2, the bearish engulfer didn't even make it there. Same story as what we just talked about in the S&P side. If we look at the NASDAQ anchored VWAPs above the entirety of the stack, nothing bearish to say about that. And we can come in here with our volume profile as well and just reinforce that, of course, there's really not much volume commitment up here. So the fact that we are over and closed over the opening print of last week just puts us in thin territory. It's brand new all-time highs. Not much to really be expected there. So all set on the weekly time scale. Bulls are in control. Let's drop this down to the daily. Let's talk about our expected move on the NASDAQ side of things, and we'll continue to move through the analysis. So expected move is here in the gray shaded area. Upper bound is going to be at 584.41, implying a brand new all-time high, a higher high in the trend count. And the lower bound is going to be at 564.69, implying a higher low in the trend count. Once again, just like the S&P side, expected move is bullish. You can clearly see in terms of candle structure, a little bit more confidence here on the gap fill reversal, in particular out of the Thursday session. It's not like we closed inside of that Wednesday range. That lower wick is a bit more expressive of stronger buyers stepping up over what could be considered kind of a sloppy 3-day balance range. You're undoubtedly still getting that candle by candle higher low, as well as even higher high through this March in the upward direction. So, I would tend to call it overlapped balance. It's not purely sideways balance like what we saw back over here, but it's not really a clean trend, right? So all things considered, we are in an uptrend. There's no arguing with that. This is an equal low. This is now an equal high with plenty of opportunity for a higher low here over 566, which, as you can see, previous resistance acted as support, acted as resistance. Resistance started to break, acting as support here on Thursday. If we could stay over 566, that's your next ideal daily higher low. Notice the confluence with the lower edge of the weekly expected move. So say the market does turn a little bit double topish here and starts to pull back, I would not change my tone to bearish on the QQQ daily so long as we're over 566, and the opportunity, the first opportunity, should be to seek that higher low. Some sort of rotation back up to the equal high. You can only knock on the door so many times before someone ultimately opens up. If we break through, it's still that same target as the S&P. The overnight all-time high here is at 577. If we go through it, upper edge of the weekly expected move, and then beyond that, I mean, maybe we could start to think of this. Let's auto zoom here. Let's come in with a Fibonacci extension tool. I'm just going to start considering this perhaps like the bull flag, right? So if we come in from the low up to the high, to the pullback low of last Friday, what is the 100% extension here bringing us to? About 590 as a measured move there. Now, it doesn't, again, this is just a forecast based on some geometry in the market. It doesn't guarantee that the market has to go there, but it might be something to carry forward in the narrative. Notice that the all-time high is actually confluence with the Fib 61.8 extension from the low of the pullback on Friday of now 2 weeks ago. So with that, we can sort of move down to the hourly time scale. There's not a whole ton of extra nuance to bring out on the daily. On the hourly chart, we can clearly see the strength of the trend. We have lows, firm higher lows, higher lows, higher lows. I mean, look at the consolidation on the Friday session right up here in the thin structure pocket from that larger gap up on Thursday of now 2 weeks ago. As long as the market balances over 571.70, this is a short-term hourly bull flag here, and Brigade Bolt that looks like this targets the overnight all-time high and then continuation towards the upper edge of the weekly expected move, and then ultimately the daily bull flag measured move as well, up around 590. You could see if we start to drop underneath 571.70, there's actually some thin structure through here. I might be inclined, if we need shorts in the market to capitalize on some sort of pullback, I would tend to think that a look above and fail on the all-time high that then yields some kind of Brigade Bolt lower high underneath 571.70. So with a failure here and an hourly shift to a lower high here, it's probably worth keeping an open mind for a breakdown through this thin structure to retarget something like 566. Now, when and if we get there, right, let's just say that the hourly trend does flip to down, something that looks like that. If we were to get an hourly trend reversal that flips back to up, which would make sense, right, based on a daily higher low opportunity here, that would be the most compelling. In the NASDAQ, if we were to break this, so let's say that the path ultimately looks like this, and then this, now I would start to keep a little bit more of that open mind to the daily double top yielding stronger downside. But once again, like the S&P, let's not call it a daily double top until ultimately we do break down through the neckline, which would be the balance range lows down here at 551. If the daily is going to be a double top, you need to break the neckline. You need to offer a daily lower low. So don't get it twisted, right? We're still, there's going to be possible bearish opportunity from point A, let's call it, to point B if a larger breakdown were to emerge, but do not call it a daily trend reversal, excuse me, until you actually take those lows out at 551, right? In the short term, right, this is still, we could scalp this move. This is okay to scalp to here, but first thought should be like this, back in the upward direction, then seeking continuation like that into the blue sky territories. Let's go, oh, actually, we don't even need a Fibonacci to gauge the retracement, but rather if we come from here up to the high, it'd be more important. So we're not measuring this down move from A to B here, we're rather measuring from B back up to C now. So the Fib 38.2 is perfect confluence with that 566, which just reinforces that so long as the market is above this level, I have to maintain a little bit more of a bullish stance, right? So that is your Fib. Let's come in with the intraday anchored VWAPs. Oh, look at that. Beautiful. The entire cluster actually is going to be very close to meeting price there if we pull back over the span of this week. Once again, 566. You can't make that number any stronger than what we've already got. Perhaps even the daily 20 SMA will start to creep up there. Lower edge of the weekly expected move. So 566 is a great spot. It's a big spot for the QQQ on the daily time scale to yield that higher low we've been talking about. Let's move into our NASDAQ side of the market internals. You could see a little bit better volume inflows on the Friday session. Thursday, though, just kind of balances that out with the outflows on the big trend day to the downside. You'll notice that the advanced decline line here is a little bit weaker than what we saw in the S&P 500, even though there has literally been an advance in the QQQ or the NASDAQ weighted. If you look at the cumulative build, very, very flat on Friday, Wednesday, and Tuesday, a little bit more bearish on that Thursday session instead of flat like what we saw in the S&P 500. Generally, this same divergence concept comes to mind in the NASDAQ. So once again, should we maybe think twice about being all in, full portfolio, long max leverage at the high if we're not really getting that support through the exchange level? Probably worth making sure you have a darn good stop loss in place before you start chasing it at the high. If you don't have a stop and there's a big liquidation break, which would seem reasonable, the market seems susceptible to that, noting what's going on with all of these indications here. If you don't have a clean stop, you're kind of you're I wouldn't say holding on to a prayer. The trends are generally in the upward direction, but seems ripe for liquidation break. And again, I'm not shorting the market arbitrarily based on that feeling. I'm just being extra cautious on the long side and chasing it at the high. You don't want to chase it with no stop. If you haven't caught that as the major drift, well, there you go. That's the bottom line, right? Do not chase the high with no reasonable stop, given that the market internals look pretty weak at this point. Here's your NQ market profile. You can see that once again, here's Monday value, Tuesday values unchanged, actually lower, Wednesday overlapping as well. Thursday gets a little bit better, and that's what we were talking about with the cleaner gap fill reversal, but still notice that the point of control was back inside of the Wednesday session. Friday is the sort of takeaway day, just like the S&P, with a big move in the point of control and value shifting higher. Point of control actually closes up and over that Thursday high over here. So generally a little bit more bullish on the NQ, but that structure to the downside still seems reasonable if we do need shorts to get the pullback. So anything that comes back down towards roughly 425, it's 23,425 is the big level. You could say like the VPOC, this Virgin point of control here, could act as a target if we need this sort of breakdown idea underneath about 615. That's the other level we've been tracking in the NQ, which would align with the exact pathing idea we just talked about in the Qs, which would be a failure here, pulls back to this area. That's the same thing that we just talked about. This would be the equivalent of 615 NQ, and this would be the equivalent of 425 in the NQ right here. Okay, that is your NASDAQ side of the market. Let's give this a little reset. Let's take a look at everybody's least favorite these days, the IWM. Let's move into our weekly time scale. Let's go ahead and throw on our study set here. Oops, there we go. What do we see relative to the clean drawing set and the candle structure? So you're still getting an inside bar. Notice the difference in terms of structure though. A little bit more of an upper wick on the IWM here. It's an inside bar with a cleaner lower high as well as a higher low. Very compressed range in here. The only bullish thing I would say about this is the fact that on the bearish engulfer, the market did not accelerate back below the neckline of the head and shoulders from back here. The not daily, but rather the weekly 50 SMA as well, the blue moving average on the screen. So we're still kind of holding up okay inside of this balance range, but I really wouldn't want to see a break back below these weekly lows in here, which roughly, to give you a level, is about that 214.25 mark. We'll see it with more clarity on the daily chart in just a second. Overall, if we bring out the Fibonacci's from the bottom of this move up to the top, we're well over the Fib 38.2. If we come in from the top here down to the bottom here, we are still technically supporting over the Fib 61.8. The more candles we close above, the higher the likelihood of a full-blown retracement to the 100% retracement, as we know. We can also check this one as well. Obviously, we're over the Fib 61.8 on this view also. Let's check in on our anchored VWAPs on the small cap side of things, staying over the entirety of the stack, which does still align with the bulls being in control also. I mean, undoubtedly you have a short-term uptrend here. It's just the fact that you're still battling these opportunities for lower highs on the higher time frame. Let's jump into our volume profile just to be congruent on the weekly chart. This high volume node is just kind of where the market's contained right now. Remember that high volume nodes usually act as targets. They're not actually going to act as great spots to initiate a new trade. Why? All this is telling us is the market's actually fairly content distributing contracts in the case of the RTY, shares in the case of the IWM. This is like perceived as fair value. That's why there's so much volume and so much share activity taking place in this location, right? So you don't want to initiate a trade here. You want to initiate a trade moving away from it, right? Once we get outside of it, okay, let's see where the next fair value spot is. Or if we get away from it and you think it's going to mean revert, that's where you can initiate the trade as well. It's basically auction theory there. Let's take a look at our daily time scale. and see where our expected move is for the week. A little bit more neutral here on the small caps. You can see our upper edge of the expected move is just an equal high up around 226.12. Lower edge is an equal low-ish to what we have back down over here. Would have been much more bullish if the lower edge of the expected move was kind of the bottom end of the balance range. When I say balance range, I'm referring to this box of price action here, which, as I'm sure you could infer, is the same exact range we were just looking at on the weekly. So in terms of daily structure, I like the fact that the market did sort of experience a little bit of look below and fail, and so far is trying to support over the bottom end of the balance here, which would indicate sellers didn't really achieve what they should have been trying to achieve. If you're a stronger seller, what you want to see is this lower high underneath the balance range to leave this as overhead supply and then attempt some sort of price discovery in the downward direction. That's obviously not what's taking place, and therefore, once again, this action, really Tuesday and beyond last week, does strike me as slightly more bullish than bearish. Now, on the Thursday session, just like the other indices, we got that big gap up and it completely faded. The only sort of saving grace is that the bottom end of the balance continued to act as support. So as long as we're over 218.60, I would maintain a bullish stance here, ultimately looking for the follow-through move to the top of the balance range. If you're not familiar with the concept of look below and fail, ultimately when this pattern plays out, the target is always the opposing end of the balance, in this case 225.50. It's also the upper edge closely, the upper edge of the weekly expected move. So still bullish here in some sense on small caps, but in terms of a gauge for the broad market overall, it's actually, if we're just being objective, it's probably just neutral through the balance range until we can actually break and set some sort of new higher high over the top end to add confluence to the new all-time highs we're seeing in the S&P as well as the NASDAQ. You're just not there yet in your small caps. Obviously, if the market were to break back down underneath 218.60, becomes a concern. This is the bottom edge of sort of that weekly threshold of the neckline we were talking about on that higher time scale, 214.75. If you want the exact number, 214.75 would be the critical watch. Let's take a look at the hourly chart. You can see how the week really resolved as a balance inside of the balance after that Monday rally. So once again, shorts are a little offsides here. I like the acceptance back in the range, but you can clearly see that next steps for buyers is acceptance over 221 over the daily 20 to rotate towards the top end of the range. If we're just balancing off in here, again, I would maintain a bullish stance over 218.60, but in terms of active upside pressure for the S&P, probably need to see the Brigade bolt and recapture over 221 with confidence to add that upside pressure. Anything that's just in here, a little bit more bullish to neutral than anything else. We can quickly throw on, let's bring in our Fibonacci's from the bottom of Friday of now 2 weeks ago to the high here. Fib 38.2 right on the dot to our balance range low. That makes perfect sense. Let's come in here with our intraday anchored view apps. These will be a little bit garbled because the price action is not quite the same as the S&P and the NASDAQ, but notice how this, just generally, I think what we should focus on is the Friday gap down from the labor report. It's perfect confluence again with that 218.60, just reinforcing that that's the key number, right? Even if you wanted to come in from here, this is the midpoint of the balance range, so it's really not all that impressive, but it is confluence with 221. This one would be a little bit better. This is the breakout day right here. And that also, see the gray line, how it follows through? It's right around in here near that 221. So the more acceptance we could get over to 221, that is a tongue twister, 225.50 becomes that upside reference point, right? Those are the small caps. Let's take a look at the Russell side of the market internals. You could see that we have pretty much the same thing as the S&P, really weak volume flows. The advanced decline line maybe looks a little bit more like the NASDAQ side with a bit more acceptance under the zero mark. If you look at the cumulative builds on the tick, kind of all over the place, pretty flat though, not really building into any lucrative thing, which makes a little bit more sense on the Russell considering how sideways the index was. Doesn't make as much sense in the S&P and the NASDAQ, which clearly developed an uptrend on those sessions. That is it. Nope, that's not it. Let's go back over here. Let's take a look at the market profile for the Russell, and then we'll get into our sector watch. What do we see here? Generally, value is completely unchanged, right? Here is Tuesday, Wednesday, Thursday, and Friday completely unchanged. So until the Russell can get some sort of acceptance, which would clearly be over this 35 mark, 22.35, with value accepting higher, it's just that consolidation inside of the larger balance range, which we shouldn't forget about, right? If we do something that looks like this, there's your larger balance range on the Russell, but until we can break the micro balance range, just really not much to read into here. So you're being patient until this kind of 4-day balance Brigade bolts higher or Brigade bolts lower. The bottom end for anybody who's been following along at home is, of course, our 2205 level. 2205 is the key bottom end. Let's go back on over to the platform here. Let's take a look through our S&P sectors. And what we really want to do is take the performance from both the weekly and the daily on Friday, considering that we did make a new high there. We want to double check who is leading the pack. So in terms of weekly performance first, you can see staples actually lead here, up 3.02%, followed by discretionary, then semiconductors, then the tech sector, all outperforming the S&P. S&P, which was still up a decent clip there, up 1.84%. At the bottom end of the barrel, it's going to be healthcare, the bond, the long bond there, the XLE energy sector, and real estate, even utilities down there red on the week. These are all, definitely defensive-esque style sectors, if not just lightweight in nature. So I actually think that the posture here is slightly more risk on. The only thing that's not concerning, but worth pointing out, is that the consumer staple sector is definitely more defensive. It's also lightweight, and yet it was the biggest performer. Now, that doesn't throw things off because we still saw discretionary semiconductors and tech lead the way also, up a decent clip there, almost all of them over 2.5% outside the tech sector itself. In terms of daily performance, though, on that Friday session, what you'll notice here is leading the pack is actually the healthcare sector. A little bit more defensive. It's no longer heavyweight, though, which becomes, I don't want to say a big concern, but something to make note of, right? Healthcare has been battered down recently. If there's going to be a stronger recovery effort there, that might actually bode well for the S&P 500. We'll see, as long as there's still relative performance from the tech sector and semiconductors, which of course there was. That was not necessarily the case in some of the earlier check-ins on the week. We had some relative defensive posturing on some of those updates. So it is nice to see the Friday follow-through did actually change that tone. At the bottom end of the barrel, it was real estate, utilities, industrials, and the bond, okay? So all set from that point of view. Let's just reset this back to the weekly, and we will check in on the structural charts. Staples, from bottom of the range to top of the range, unfortunately, has not broken out. Really don't have any big comments here until we're up and over 82.65 or under 80. Don't get me wrong, upward pressure is upward pressure for the index, but it's not doing anything impressive. If we look at discretionary, I love the hold of the top end of the balance range. We talked about that earlier on in the week with the Monday hold back over 217.65, Wednesday's follow through back over this as well, which was the double top neckline from back here. I like what I'm seeing. As long as consolidation can persist for a higher low relative to this, I think that we're all set. So any sort of higher low hold over 221.75 would be ideal. If it goes a little bit deeper than that, you kind of fall into more of a neutral balance here, but it would be progressing in the upward direction overall. So I can't really take a bearish stance here on discretionary. If sellers were going to make something happen, it really should have happened earlier in the week with a failure back into this range and acceptance here. Obviously, that's not the case. Let's take a look at semiconductors. Another one where if bears were going to make something happen earlier on in the week, what's going on here? Why were sellers unable to really follow through underneath what could have been considered the neckline of a head and shoulders? Here's the neckline. There is your Wednesday session actually testing the neckline, no break. So with no break there and trading back up towards the equal highs, have to maintain a little bit more of an optimistic stance. Let's move into the tech sector. You can see that this, unlike the QQQ, actually still has a lower high potential here on the daily. Now, I'm not going to say that this is bearish because you can clearly see the acceptance outside of this multi-day range after the pullback here. So as long as the XLK is over 262.85, cannot really be a bear. This is actually a bullish 3-bar play, setting up for the break of the 2-day high to get back to the all-time high early on in this week. So simple trade to watch for would be if the XLK opens in range here and breaks the 2-day high, probably looking for a bullish day in the S&P to trade into this all-time high and then reevaluating. Do we double top there or do we just blast right off through it? Next up, we have the XLB materials sector. It is under the neckline of what could be considered a double top, but what I find most interesting here is that the home builders continue to move in the upward direction. So for the cyclical side of the economy, I actually think that this is doing all right. Moving into the communications sector, you can see the consolidation. Generally, this is just a weekly bull flag up here. If we can get a break into blue sky territories again over 108.50, that's obviously, you have to contend with that true all-time high. But if we can get over the balance range high, that would strike me as being more bullish for the index overall. And as of right now, I wouldn't really take any bearish stance on it until we're explicitly underneath 105.60. All week, you can see the consolidation was above. So really no concern here out of the XLC yet. If we look at financials, this is a little bit more concerning, noting that your double top neckline is in play after this lower high consolidation, the big bearish engulfer on Thursday. Watch your neckline very closely here in financials. Underneath 51.25 starts to become an issue. For further downside, probably targeting something like your daily 200. You can start thinking about this through the lens of perhaps, right, weekly Man Ray pattern. If we build out something that looks like this, larger concerns would emerge if the weekly trend were to flip to down. I'm not guaranteeing that. I'm not sort of saying that we need to forecast it playing out that way, but it's a threat to the broad market that we should pay attention to, noting that the XLF is now the second heaviest weighted sector by market cap. right? It has completely dethroned the XLV. XLV fell off of a cliff. So XLI, excuse me. What do we have here? A little bit more neutral, a little bit lackluster, still an offering of a lower high. Ideally, I'd like to see follow through in the upward direction. No concerns in terms of general change in sentiment until we're underneath 148.25. Next up, we have the healthcare sector. You can see it's just playing nicely off the bottom end of its balance range. If you take a very simple approach to technical analysis, right, whenever you're in a balance range, typically what do you want to do? You want to buy the lows and you want to sell the highs. So as of right now, if this is going to be a classic case of buy the lows, mean reversion, I would think that generally this would help upside pressure in the S&P 500. We'll see where it lands. If it does start to crack underneath 129.25 more explicitly, something that looks like this, larger concerns would emerge, but we are not there yet. Let's look at the TLT long bond, higher low opportunity here. I'd be a little curious to see what happens on CPI. If CPI does drop, and let's say that CPI comes into the 85 handle out of the TLT, I might be interested in selling some puts down here if the CPI report is not egregiously bad. It could be, obviously it would have to be bad for the TLT to start gapping down, but not to a certain extent, right? We'll have to monitor that. And of course, we'll be live in the pre-market prep up in the Penthouse office, of course, on Tuesday morning to gauge the response from the market. We'll probably talk about whether or not the TLT is going to be a short put sale trade on the open. But for now, it's just an idea that you should have in the back of your mind. All right, so 85 key level to watch if the TLT gaps down. If inflation comes in and it's a nothing burger, it's no issue, then expect the TLT back up to this equal high, if not potentially trying to make a break in the upward direction. Here's the energy sector, not much to talk about here inside of the balance range. Real estate, not much to talk about here until it's underneath 41, and utilities, sort of sideways, but it has been a relative outperformer. One of the concepts, and we've talked about this a little bit on the channel over really since the AI revolution, and it keeps getting brought up in the pre-market prep, so I do appreciate everybody who does reinforce the idea, but the question becomes, will utilities no longer act as a risk-off sector when the demand for AI and data center is going to drive utilities, the building of utilities infrastructure, and then number two, the actual use of utilities, right? So that's something to consider here. Is it going to deviate from the risk-off posture that is typically represented? I'm not convinced that it will, just because it is, relative to the bond market, it's the most similar for good reason, right? It acts in a similar nature. So with that, we'll keep an open mind, but for now, this at least is not jamming new all-time highs as the QQQ is as well. You can see clearly here the lower high and the relative underperformance on the week, down about 5 basis points there. Let's check in on the ratio charts just to get a sense for risk on and risk off. If you're not familiar with these ratio charts, check out the video tutorial in the top right-hand corner. This is still the glue that's holding the market together. This in a picture-perfect world will not break down underneath this level. It needs to turn for a higher low almost immediately early on in the week. We'll see if Tesla and Amazon can do that for discretionary. Financials, again, this is a big threat for the market right now. And communications also not really holding the ideal higher low to yield the inverted head and shoulders. So a little bit of an issue there on comms. Not fully risk off with staples still underperforming. Utilities, as we just talked about, a little bit more neutral hanging out towards those highs, but I would not say we have a full-blown risk off style look in the market, and our risk on off A-B sets will also agree. This is making a new high. This is recovering over the daily 50. This made a new high. This is still kind of neutral here. This is staples versus discretionary. That, of course, is always a very what would you say, standard way of looking at risk on versus risk off. You're not, skewing basically the most risk on sector versus cash is the equivalent of this SHY here. This is still doing all right. I'd like to see it really start turning back up towards a higher high or an equal high, and this just continues to chug along. So once again, at a top level, we're not really seeing a flip to a risk-off style market here. If we look at the B set, you'll see the same thing. Gold still exists in a downtrend relative to the S&Ps. This is rejecting for a lower high TLT ratio to the S&P. The Sailor Shift tool did fire off a red Bitcoin signal here. However, you can clearly see that structurally, there's no issues with the Bitcoin chart. I'll actually just go full screen here. I still maintain the Bitcoin swing trade that we put on when this trend line was breaking back over here. This is a great example of a Brigade bolt, right? Break the previous high, come in for a retest, hold it, and then go. Great opportunity for a possible higher low. I'm going to maintain that Bitcoin swing trade. Ultimately, the ideal target here is north of 130,000. We'll see if we can get there over the next couple of weeks, perhaps, or next couple of months even. We would like to stay in this as long as this low now holds. Let's jump along into our dollar and interest rates. You can see that the dollar did not hold its ideal spot for a potential higher low here. If the dollar was going to build out a more structural uptrend that was clean, I would say that's a headwind for equities. The fact that this has deteriorated so much, a little bit less pressure on the equities market. TNX, I would say that we really want to take it easy here until there's a big break of this balance range. Really, rates have remained stable for quite some time now. There's been fluctuations, don't get me wrong, from the top to the bottom end of the range, but has there been any actual trend in interest rates? The answer is no. If rates are going to come down, if inflation is going to be a non-issue on Tuesday, I would watch very closely to see if rates can move underneath 4.2 on the 10-year. That would be your signal there. Let's take a look at, let's get into the inverted ZT, which is going to be our Fed tracker tool equivalent. Small uptick here. I would imagine that the odds might still exist somewhere around 80% for a rate cut in the September timeframe, but let's not guess. Let's just go take a look over here at our Fed tracker tool. Yeah, 88.9% odds you can see right here, because right now we are at 425 to 450. So that's 1, this is 2, and this is 3 rate cuts into the end of 2025. That's up from the S&P, which estimates about 2 rate cuts into the end of the year, based on Jerome Powell's commentary in the previous FOMC. He was kind of like, you're lucky if you even get any rate cuts into the end of the year. So market's pricing in 3 on the premise that the labor market's much weaker than anticipated. If we look at the calendar from the... Oh, let's look forward before we look back. Looking forward to this week, we all know it's CPI, right? We've talked about that a number of times in the video today. We will be live at 8 o'clock Eastern time, as we are every day. But on Tuesday in particular, we'll watch all together to see what the reaction is from CPI at 8:30. We're live every morning, 8 o'clock. That's when the pre-market show kicks off, right? Aside from that, you get PPI, which is another key component here. So the market can price out PCE, which is the Fed's favored gauge of inflation, when it has the CPI and the PPI numbers, a combination of those two, and the market kind of understands what PCE should look like. Jobless claims will be another big watch. The market did get okay jobless claims, kind of unchanged on Thursday of last week. I wouldn't say it caused the big move to the downside on Thursday, but we'll see. It was really more headline driven with the semiconductor tariffs, right? You get retail sales on Friday, as well as this is always market moving, so please keep an eye on University of Michigan consumer sentiment and inflation expectations. The preliminary is always the major one. And what I would just point out here is inflation expectations were basically off the chart. If we scroll back, right, this is the highest read literally that we've had on the chart in almost all of the data that we can see here from at least Forex Factory. I do think we have a little bit more data going back to earlier 2000s. You don't hold me to that, but generally highest reads ever on the announcement of tariffs, and you can see that we're coming back down more meaningfully. So as long as this trend continues of like, oh my goodness, spike to panic, and then we're back down, I think the market is kind of okay with that. If we start to see a re-acceleration of inflation expectations, that would be an issue that the market probably does not like so much. So that's Friday of this upcoming week. All right, that is what we have here through the calendar. Let's look back now and sort of give ourselves a forecast for what might actually happen with the CPI print. What I have here is the ISM non-manufacturing, so basically services, prices paid versus the inflation rate. And what you'll notice is that the services prices paid actually leads inflation by about 6 to 9 months, give or take. You can see here that prices paid actually peaks, and then inflation peaks a little bit further out, right? So this is December of 21. This is June of 22. So in this case, it was much longer than the 6 months there, right? So, or actually, yeah, a little bit longer. So about 9 months in terms of this peak to this peak. So we'll see with these prices paid aggressively ticking higher. Look at this. Aggressive uptick higher here, yet inflation continues to move in the downward direction. So this divergence is not good and would typically indicate that inflation should start creeping up in the near-term relative future. All right, so that is your little forecast that inflation moving higher, probably not unreasonable. We can see that the expectations here are a forecast of hot on the month, and on the year over year, also an uptick here. I'm curious to see what the core would also look like. Let's go to the calendar. Let's have a forward-looking, this is last week. Let's go to next week. There we go. And core year over year, expected at a 3%, prior at a 2.9. So, you know, in terms of all the people saying there's no inflation ever since, the new administration stepped in, it doesn't matter if you annualize it on a weird basis, starting at a certain point, the actual rate of inflation is still over the Fed's target of course, 2%, which is going to mean that if you drop rates, expect inflation to come back with a vengeance, right? So that's we'll see how that argument continues to sort of develop on Tuesday. I'm sure there will be some funny tweets posted about that. Here's the earnings calendar. A lot of retail names that'll be kicking off this week. We have Big Bear AI. Oklo is a popular one. Let's forget about AMC. Let's leave that in the dust. ASTS, Space Mobile, Archer as well. So all these names retail has been fairly obsessed with. Circle, new IPO. CoreWeave, new IPO. We have Rigetti, which of course is quantum there. Kava will be interesting. What else is possibly worth an honorable mention? Cisco. It's got a nice looking chart actually recently. What else? I'm sure there's other retail names in here that people are focused on that I'm just not picking out. Applied Materials strikes me as interesting. That of course is related to the AI chain, the semiconductor development side of things. Probably, I think that's mostly where I would be focused. That's probably it for me. I'd love to hear from you in the comments section if you're like, no, you missed this one. I'll go take a look. But for now, we can move along to the earnings insight. What I find really compelling based on the FactSet report, there's actually a revision here. If you recall, the last time we looked at this number, it was down, right? We were still expecting a lower quarterly earnings than the Q1. And this has now been revised, or based on the actuals that are coming in, to over the Q1 of 2025, which is actually bullish and probably starts to justify a little bit more so the move higher we've seen in markets. If you look at the revisions to earnings estimates, look at this big uptick over here. That is a pretty substantial, not just revision, but updated forecast, right, of the total calendar year 25 EPS. So that is bullish. It would help the narrative that markets do belong at this elevated valuation. The next thing I want to talk about, just because it was huge fundamental news on a stock that has been dormant for like months now, is the Apple investment of $600 billion over the next 4 years in American manufacturing. I just want to say that this is my opinion. I'll tell you when something's my opinion, right? We always do this when it comes to this segment of the show. My opinion is that this is just a total knee bend, and I would not expect this to come to fruition. Why? Let's just look at the numbers. $600 billion over the next 4 years. Okay, Timmy Apple, what's your actual income statement look like? Well, your total revenue over, year over year based on the last earnings report is $94 billion. So you mean to tell me that you're going to invest more than your total revenue over the next 4 years? What does your current investment look like? I mean, let's just say research and development, right? Kind of investment in new opportunities. $9 billion, perhaps? You're going to invest 10x that? It just doesn't make sense. The numbers literally do not add up. So to me, it's a little bit of a knee bend from Apple to the administration. I think that this does not pan out over the span of time. Don't get me wrong. I'm not betting against America. I would love to see America continue to succeed and do what it needs to do. But just in terms of the Apple price movement on the stock itself driven by this headline, seems like a knee bend from the company and therefore a knee-jerk reaction from the market, right? It's making the market happy. It's doing all these things, but does it stick? I don't know. If it's going to allow them to dodge tariffs, maybe it's just a strategic play, to dodge some of that tariff stuff. And then, we'll see where it winds up in the next 4 years beyond. So I don't know. Just pointing out that the numbers literally do not add up. All right. That's all. Numbers don't add up. Make of that what you will. Let's go back on over to the platform here. Let's take a look at the bond relationship, see what's happening there. So market's not really as concerned about inflation, at least the bond market's not pricing it in. The long end of the curve is not, aggressively breaking to a new high. We'll see if the CPI report changes this, but as of right now, it still seems as though the market's a bit more concerned about that labor side, which has kind of been the narrative for a little while now. Credit spread's actually hooking here for a possible higher low on the shorter end of the duration, i.e. FLQD. Medium end. This is medium, this is short. So more medium term is saying, maybe expect a little bit more volatility there, but what we'll see on the VIX and volatility futures is like not even at all a concern. One of the other divergences that I wanted to point out, so I said that there were 3 in the introduction. If you made it to this point in the video, here's your second. The first was the market internals. Number 2 is the LQD. Corporate grade bonds have been on an absolute tear in here relative to the S&P, which has been more sideways and flat. You can see the HYG is even sideways and flat. But notice that as the market made a new high, the SPX, let me just throw that up here real quick. So as markets made this move, the LQD actually made this move. Okay, so it's been leading a positive bullish divergence through this move here, but now it's actually starting to neutralize a little bit more so. Again, not enough information to just go out there and short the market with both hands, but it does make me a little bit more cautious about the move higher, right? So that is in play out of that. Let's jump into the breadth chart. This is going to be your divergence number 3. What we had through the rally earlier on in the month of July, basically, is if you take a look at this breadth, it was really expanding. It was nice and solid up here. This pullback, it's not really accelerating back up towards these highs. So divergence number 3 is your breadth, and you can actually see new highs versus lows. So the moving average charts ticked higher, but your actual breadth, new highs versus lows, ticked lower on that Friday session. Why would that be the case if the market's actually making a new high relative to the prior day? Not really being supported at the exchange level, which is exactly what we saw in the market internals anyways. If we jump into our RSP, what you'll see over here, excuse me, is the same thing. I mean, it's just not even close. It's a huge divergence, RSP versus the weighted SPX down below. So divergence number 1, market internals not adding up. Divergence number 2, LQD pulling back. Divergence number 3, market breadth, which is pretty related to but rather divergence number 1 is just breadth overall. RSP is massively divergent on these lows, as is if we take a look over here on the QQQE, not even close, right? Look at the QQQE as well. So question becomes, what was driving the upside in markets here? Well, look no further than your main suspect, Apple, right? Up 3.86% on Friday, right? Look at your heavyweight companies, Google, Tesla, right? Look at Robinhood. That's not really heavyweight in the market right now, but it's definitely up there in like the top 50, right? So that is what we have in terms of divergence. Let's jump into our volatility look. If you look at the VIX, got crushed here on the Friday session. That is bullish for markets technically. If we come into the VVIX, you can see it's slightly lower. It's not in this sort of caution zone anymore. That's bullish for markets as well. And if we take a look at volatility futures, huge push higher out of the contango charts. So that's money managers like that. Same thing here, 9 versus 30-day VIX. And the 1-day VIX is in its comfort zone here underneath 1275. So really no major red flags outside of the 3 things we've really pointed out. Again, it's not enough to just short the market with both hands. I would still lean into a bullish edge here. However, we just want to make sure we're being a little bit cautious about longing the market at the highest high without knowing exactly where your stop loss is going to be. That's the bottom line of the analysis so far on today's session. With that, let's get into the core list of companies. NVIDIA is going to kick things off. Earnings still further out on this one. They're always the laggard, which is honestly a little annoying, but it is what it is. Little inside bar on the Friday session, which I like. The Thursday session left a lot to be desired in terms of the actual range and the structure of the candle. If we can break out of the inside bar high into blue sky territories, looking for upside. Very simple chart to watch. Over all-time highs at 183.50. Target the overnight all-time high at 185.45. You can see that here on the hourly as well. Look at this great consolidation over this previous pivot high. It was the opening print of Thursday as well. If you get this consolidation to continue, you just have nothing more than hourly higher lows seeking a continuation play like this. If you get this, I would still be open-minded to buyers stepping up here for a daily higher low over this pivot, although they have already done so once on the Thursday session anyways, filling the gap there. So I'm bullish NVIDIA here over the highs, and even on pullbacks, I would maintain the bull stance, ultimately seeking this over time. Where I start to get bearish is probably under 174. You might be like, dude, that's like, what are you talking about? Why wouldn't you just get bearish here? You could maybe scalp the downside, but I don't think this range is going to be all that lucrative to short through. I think you really have to crack the 174 before things start to accelerate lower, primarily based on the daily, right? You can see the daily chart here. This is really just consolidation. I would think of this, as a weekly bull flag building out. All right, that's NVIDIA. Let's move along to Microsoft. Gap fill reversal, here's the play. So you have your previous highs, gap fill, possible reversal over the inside candle high on Friday. If we get something that looks like this, here it is on the hourly chart. Notice the subtle shift via the higher low here and the higher low here. Flat highs, call this a double bottom, call it whatever you want, over the neckline at 523.25, seeking upside through some of this thin structure on the breakdown, ultimately targeting this level at 535. Microsoft has been one of these charts that is not really lucrative to trade intraday. I'm going to rely on the Kramer approach of just own it, don't trade it. Okay, same thing that Apple used to be. Speaking of, let's take a look at Apple. Here's your big break to the upside. Again, it's like the chart's fine. It makes sense that breaking out of a balance range like this, you would have all this pent up energy. It needs to be released. You could think of, markets have kinetic energy and potential energy, just like any other object in physics. So, although do shares count as being objects? If you get a paper share, does that count as being the object? Point being, price momentum here out of this long-standing balance range makes sense. And you can see that we have nearly come into the range double. The thing that I would be watching out for here is if the market out of Apple pulls back, you have to almost guarantee that it holds a possible higher low here. Otherwise, this is just totally dead. I think the market is calling BS on the investment plan, like we've sort of run the numbers on real briefly. If you fail 213, if you notice Apple ever starts trading back down here, just kiss it goodbye. Not going to happen. Sayonara. Nice knowing you. It was fun while it lasted, but just button it up and let it go. right? So 213 is the must-hold high or low. To the upside, just to reference some targets above, you have the origin of the breakdown at 235.75, and then these pivot highs up here, 240, 250, 247.25. On the hourly chart, there's not much to read into. You could see that if we come into the daily 200, you could look for a higher low possibly over the breakout level from the Friday session as well. Really, it's not an inside bar, but the consolidation, all hourly inside candles relative to the first session of that Thursday, that's 220.75. All right, so that's Apple. You could slap a fib on it as well. Little fib retracement from here to here. Yeah, look at that, daily 200. So I'd say focus on 220.75 if there is a larger pullback. That's probably where you want to start to establish new longs for a potential upside move for continuation. Let's jump into Amazon. I like Amazon in the gap here. What I don't like is the lack of momentum. So just an inside candle on Friday here would need to be over the Thursday high at 224.75 to get continuation into the gap close. I would honestly be interested in Amazon underneath 220.50, maybe as a short depending on broad market strength, but then really reevaluating to see if 217.75, the neckline of this inverted head and shoulders, could act as a possible support point, offering a daily high or low. Right, so flip into the hourly downtrend to get there under 220.50, and then 217.75 steps up, and then we see this for possible continuation here. Oops, that's a little bit of an overshoot, but you get the idea, to close the gap 231.30. All right, that's Amazon in a nutshell. To really be more bearish on Amazon, you'd probably have to fail underneath these lows here. I mean, don't get me wrong, there's going to be bearish shorting opportunities possibly through this, but generally on like the overall structure of the chart, you'd have to start taking this out to get more bearish on Nancy here. Let's move into Google. Great little gap close on the Friday session. I believe, let's go to a weekly chart here, if I'm not mistaken. Yeah, this is all-time highs back up here. So Google on the march. In terms of upside action next, I think it's very clear in terms of what needs to happen. Pull back for a Brigade bolt over 198 or continuation over 203, which is the gap close, and then you literally have the all-time high to be aiming at. Let's go ahead and throw that on the charts here at 207. What is the actual high of that bar? High is at 207.05. 207.05. I mean, knowing me, I'd like to use a round number, but we'll go with the exact all-time high here. ATH, let's show that on the right, doing a little bit of homework with you guys here on the screen together. There you go. Okay, so on the hourly chart, you can see this very clearly. Nice break, higher low, right from here to here, break into the gap. Closed it almost all in one session. Next follow-through move is either this, here, back to here, and then here, or just this in general gets you bullish on Google. So that's what I'm watching for. Next up, Metaverse. What's going on with Meta and the Zuck? No breakdown, although I'm still interested in this possible idea. You have highs, lower highs, possible lower highs. If we revisit the lows, I'd like to look short underneath 760.25 for overhead supply to at least bring it back down towards the previous all-time high at 745.50. If it's just chopping around in here, I don't really think there's a play. At least there's not a play for me. If I look at the daily chart, I'm really not interested in doing anything here until there's like a Brigade bolt perhaps into blue sky territories. Not interested in trading this balance literally at the all-time highs. Maybe interested in something that looks like this if it's going to offer a secondary entry off of this prior pivot. Okay, that is Metaverse. Let's take a look at Tesla. Tesla, great move on Friday. I gotta say, Friday, the execution, not my best work, but nonetheless, still a great looking chart now that it's broken the trend line. We've been fairly concerned about Tesla, primarily in this range. I think that it's clearly starting to display some momentum here. If we could stay over the moving average cluster, if we could start to take out this pivot high at 334.50, I would love to see this continue and like actually do something out of this triangle that we've been mapping, right? And, you know, we're not special for calling this out. Nobody is really special for calling it out. Everybody can see this. If this is finally going to be the move that makes it actually move, maybe Tesla starts to become a more usual suspect in the rotation. The one thing I do like about it is that on the breakout on Friday, there was slightly more volume than what we've seen on the prior day, as well as the prior breakout attempt here over the 2-day balance range, still underneath the moving average cluster. So not a lot like the earnings volume, but still an uptick nonetheless. It just makes me think that people are starting to pay more attention to it now that it's on the move. All right, so that's Tesla. JP Morgan, what's going on here? Not much to talk about on financials. So underneath, take a look at the hourly actually, because there's a weird intraday breakdown. See this thing here? It quickly got bought back up over that 288.25. So if this just remains in range, wouldn't really be bearish on the XLF, but if we do start to crack this, I would make note that this is like your absolute line in the sand. I would start to become more bearish on the XLF and thus the impact and influence it has over the S&P if JP Morgan's not holding 280.25. Next up, Palantir. Just an absolute rocket ship into blue sky territories here. Let's take a look at obviously the daily chart speaks for itself, but the hourly chart is where we want to go because Friday was really nothing more than an intraday balance. Yes, it was a gap. Yes, it initially ran, but there's really really not much follow through to the upside. If this is going to represent some sort of form of consolidation, if you can get the Brigade Bolt to blue sky territories, that's your next attempt to upside. Or if this is going to start looking like distribution, I'd be very wary of the opportunity for this. Anything back in range probably offers a deeper pullback, right? And that's like A-okay. Don't forget, it's okay for stocks to pull back. It's actually the right thing for the stock to do. Stocks can't just do this for forever, right? Until ultimately they warp time, they start trending backwards, and then they do this, and like all sorts of funky screen art can start going on. So a pullback or sideways consolidation here would actually be okay post-earnings gap up to digest some of this action that we've seen in the upward direction. We can have two all-time highs. This is a previous all-time high. There we go. Let's come into, and so that for that reason, it's pretty simplified watch here. Either this and very cautious, or this and just let it go and build out new structure, right? Next up would be Broadcom. Let's take a look at AVGO. A little bit of hold here on the Friday session over 302.85. Go to a 5-minute chart. This is almost like too funny. Look at this move here, right? Some really odd, and you could also look at, where is it? Low. Look at the low. 302.85. What's that? 302.85, right? It's not always that precise. It's just funny when it is. It's not really a pat on the back. It's just an observation. But look at that weird pop. Look at this kind of thing happening here. So I do believe Broadcom is still in control of buyers as of right now. And you're trying to build out lows, higher lows, higher lows, higher lows. It just becomes a matter of how do we actually participate in terms of upside. So all-time high as a target there, 310.25. If you could hold 302.85s, longs off of the level, risk, reward like that. Those are the ideas on it. I would not start changing my tone to short Broadcom until this dramatically changes trend on the daily or the hourly. AMD, really sideways session slash, intraday, up, down, down, and then up. Sideways in the sense of not making a lot of progress in terms of the hourly trend. It's in a box here. What I'm interested in watching on AMD, believe it or not, is see these upper wicks. I would like to see if AMD could break underneath 170.75 to pull back into at least 167.15, confluence with the daily 20 at that point in time. I would like to try for a little bit of a short here, noting that you have highs, lower highs, lower highs. Be interesting to see whether or not this plays, right? Clearly not much price acceptance over 174 here. If you can drop this, there may be a quick lucrative trade to the downside, A to B. When we get to point B, when and if we close this gap all the way, there's a little bit of unfilled gap there, then I would tend to start thinking back on the long side, trying to align with daily trend, which clearly has been up over the last couple of months. So a short-term downside move, and then if AMD is going to break kind of this resistance trend line here, that's where we start trading longs. It has to be acceptance over 174, but we didn't really see evidence of that on the Friday session, right? There was an attempt to hold above, but it was very short-lived and did not yield further upside. Okay, next up, Robinhood. What else is going on with Hood? Nothing more than just new all-time highs. So consolidation here, bull flag, continuation into blue sky territories over 116.25. If it pulls back, I think everybody would agree that some sort of hourly higher low or a daily higher low even around this gap close area gets very interesting. That's 107.50, 105.85 would be the gap fill reversal. Okay, that is Robinhood. Let's take a look at these 4 additional ideas I have for you, and then you're on your way. UNH, can you believe that? Shiny object syndrome. I have been a staunch sort of steer clear, right? Do not touch UNH. Well, for good reason, right? There was really no change in character out of UNH, definitely ahead of earnings. That was ugly, ugly, ugly here. But notice that the downside started to actually form a higher low on the daily time scale. Very, very subtle, but it's starting to emerge here. And I do kind of like this as a possible double bottom, right? If you're going to break something over, how dare we let this slide at 252? Jeez. Let's go 50 flat, round numbers only up here in the office. You could see on the hourly chart that there might be some sort of trade to unfold. Notice what I'm saying here. There's a trade that could unfold. I do not believe that UNH is something that you should just be buying and blindly holding, expecting it to go back to 600 or whatever in the blink of an eye. Healthcare sector is going to need some massive reform before this becomes an investment again. But as a trade, I think you probably have a decent amount of overly short participants based on this. Just everything points to a lot of short activity on UNH. If you're going to pinch out some of those shorts, you finally have a little bit of a character change, a little bit of a higher low, well-defined neckline. I think you can manage risk against that level at 251.50. I'd be curious in terms of sort of watching that into the early stages of the week, right? Finally, when everybody's like, oh, geez, I got hammered on earnings on the long side. I tried to buy the dip over here. It didn't work. I bought the dip over here. It didn't work. I bought this, and we're kind of going sideways now. Sellers are like, nope, you're silly. I've just been shorting this the whole way down. Those sellers come under fire a little bit over that 251.50. So although I've been avoiding this like the plague because of shiny object syndrome, the chart does finally start to offer something a little bit interesting here. Let's move to the next one, TSM. Taiwan Semiconductors, you could see the hammer candle on Friday, perfect low right off the daily 20. What I find more compelling, though, is just the close back inside of the Thursday range, which was a massive gap up, of course, on the semiconductor tariff news. So if we could stay inside of Thursday's range, that's a good step, and then an actual break over the hammer high probably yields a move into the all-time high? Yeah, all-time high here, and then just seeking continuation. This is an overnight all-time high at 253. On the hourly chart, you could start to see, right, if you can hold this, so consolidation here, then Brigade bolt like this over 243.75, these prior pivot highs, and this, very close to the opening print of Friday, that's where I would start fishing for longs risk-reward wise into the all-time high here, thin structure, thin structure, thin structure. All right, so TSM long side over 243.75 with our semis. Let's move along to Netflix, NFLX, rest in peace, off the core list of companies, almost untradeable these days, or at least it was, at the rate it was moving intraday. However, as a swing-ish opportunity or chart to pay attention to, notice how the sellers failed to really break down more aggressively under what could be considered, head and shoulders neckline here. There was a break, but we've promptly recovered that. If there's any higher lows on the daily chart over 1185, I would tend to be a little bit more bullish. Right, you could see here the nice break on the Friday session. If you look at these prior lows, they've been recaptured into the end of day. Even if you pull back to here, I would maintain the opportunity or the stance that the chart could offer a higher low at that level, and then seek upside continuation for some kind of move higher over time. I would, the thing about this is it's just very easy to manage risk up against the top end of this range. Sellers feel like this. If we're above that range, buyers start feeling a little bit more happy. Right? So you could put a stop kind of in this area and say, okay, can we get some upside rotation? Here's your risk, here's your reward over the span of time, right? So that's Netflix. And last but certainly not least, let's take a look over at Coinbase. This might require a little bit more time to build out, but I want to start on the daily. Let's remove this alert for now. Notice these prior highs, right? That's the first part of the thesis. We have a big breakout into those prior highs and then continuation beyond it. Earnings gap down straight into those prior highs, and now on the hourly chart, you could start to envision how we maybe have the offering of a little bit of inverted head and shoulders. Now, it's not built out picture perfect. I would not say let's throw this in a textbook. This one, perhaps, we could throw in a textbook, gap up overnight. But generally, I would start to be a bit more bullish Coinbase if we could get over 313 and then probably getting in sort of some kind of long trade, long structure here over 321.65 to 337.25 for the Stevie Wonder, right? That's the pinch up and over these highs. So I'd like to continue monitoring this. I'm not sure it's in play as soon as the market opens up on Monday of this week, but over the span of time, I think it's worth watching Coinbase at that previous structural high we were just looking at off to our left. That is going to do it for today's episode of the Weekly Watch List. If you enjoyed the video or learned anything new, feel free to let me know down below in the comments section. No coughing today. We are on the mend, or at least very minimal coughing, I should say. We're on the mend. It's sort of the changes in latitude, if you will. North office, south office, the whole 9 yards. So feeling good. Again, if you enjoyed or learned anything new, if you just appreciated the non-coughs, let me know down below in the comment section or by giving the video a very simple thumbs up. As always, we're live every single morning at 8 o'clock Eastern time here on the channel, live and open to the public. Come join us for the pre-market prep. If you want to continue live analysis as the market's open, feel free to check out the links listed down below in the description. The live squawk is what you're looking for. If that's what you're interested in, other resources down there as well. Check it out. With that said, have yourself a green trading week, and as always, I will see you in the next one.